Welcome to the Tax Talk podcast and an exciting episode with Bryce Kander. Bryce is a realtor with Realty Executives Alberta Elite. He has been investment-minded and interested in real estate from a young age and can see the future potential in land and people when others cannot. Bryce loves helping people find long-term success, especially through purchasing suited properties. Bryce, thank you very much for taking some time out of your busy schedule to hop on the podcast today.
Oh, thanks for having me. I'm a soft talker, so I'll have to...
Right on. So we are going to be looking at an episode today titled Building Wealth with Real Estate. We're going to do things a little bit differently. Typically, I am the one to be asking the questions and the guest is providing some responses, but Bryce has decided to run some of his questions by me, and hopefully I can provide a bit of advice in the realm of real estate, tax, depreciation, all those fun things to kind of help you build some wealth via a real estate portfolio. So, Bryce.
Yeah, you guys should have been tuning in before we even started. It was really good. So my first question for you, Jared, is if I've fully depreciated my property, how does that affect my estate?
Perfect. So we're going to have a couple things that we need to look at here as far as estate taxes go. That property is going to be disposed of on that terminal tax return. And you're going to have to look at a couple things, one of which being the ACB of the property, your adjusted cost base, and the other, your UCC or your undepreciated capital cost. So that's the tax cost of the property. So when we're looking at these two items, on that final return, you're going to have that deemed disposition at fair market value, and we're going to have to complete both that ACB and the UCC values.
Okay.
So the capital gain on that property is going to be determined on fair market value and the ACB. And then any potential recapture tax that you're going to have to pay would be determined on those proceeds less that accumulated tax cost that the tax return should be picking up for you on a regular basis.
And this is why I wanted to ask him, because you want to ask the expert.
Always important, for sure.
So how much can I depreciate my property per year? And is it based on, I know you just explained it, but is it based on market value or purchase price?
Gotcha. So what's going to happen initially is when you purchase that real estate, you're going to be kind of in that boat of having to determine what's the land value, what's the building value, and being able to split those out to get them into the applicable CRA, CCA classes. So basically when we're looking at the building, typically that's going to fall into class 1. It's going to be depreciated at 4%. So there's a number of, I guess, modifications that CRA has put out to the CCA classes in recent years, some dating as far back as 2018. Another one of which kind of came through during COVID times. Both of which were kind of geared to, I guess, get Canadians out there, get them investing, being maybe not so burdened with those upfront costs. Because, you know, if you're purchasing, you know, equipment, buildings, etc., it's a fairly big outlay of cash. So if you're able to accelerate some of those claims, get a little bit of a tax reprieve, get some cash flow in your pocket, and you're able to kind of push that investment business or that, you know, small business out ahead of time. So that would be your biggest one, is just kind of getting that initial determination of that building and the land, getting that building put into that class 1 asset pool.
Okay, sounds good. And so what, just a broad statement, how much percentage would you say the land is versus the building when you first buy?
So I guess there's a couple ways to look at this. In recent years, you know, if you purchase that property, you've got a recent property tax assessment. Sometimes those values will be broken out on there. You can pick up the land and the building there. That's one way to kind of look at it. Sometimes, depending on, you know, how you're purchasing that property, who it's with, maybe there was an appraisal done on it, you could pick up those values. Worst comes to worst, kind of looking through historical trends, we would typically say if you don't have some of that finer detailed information available to you, typically you could allocate about 2/3 of that initial purchase price
Okay.
to that building and then 1/3 to the land. It seems to be a reasonable kind of go ahead as far as dividing up that value.
Awesome, thanks for the answer.
For sure.
Can you explain the different types of depreciation classes?
Sure. So there are a wide variety of classes out there, probably a few that are going to be more applicable to the real estate.
Okay.
One that we talked about already was class 1, where your typical building would go into,
See the previous video?
correct? The second one being class number 8, which would usually house your equipment. So those would be anything like stoves, fridges, etc.
Oh, appliances.
For sure. And then lastly, this would apply if you buy a property that has a fence, shed, etc. Those would fall into class 6, and those would be depreciated at 10%.
10% of my fence. I can depreciate my fence. Ha,
You
I've
certainly
been missing
can.
out on depreciation.
There you go.
That's awesome.
Learn something every day.
Yeah, I didn't know that. That's
Right
cool.
on.
So Airbnb is a hot topic right now.
Mhm.
Can I depreciate my Airbnb furniture, my cutlery, my artwork?
For sure. So again, some of that's going to end up into that class 8. So the furniture, the appliances, etc., that gets depreciated at a typical rate of 20% if we're kind of ignoring some of those accelerated amounts. If we're talking utensils, maybe some of those things that are not necessarily a consumable, but they're pretty close to it, those are going to get put into a class that basically essentially writes it off at 100%. So what clients might do in those particular cases is maybe you're trying to present a picture to the bank that you've got some assets. Instead of expensing through a whole pile of these purchases, you might set them up as assets and then just depreciate them through.
Yeah, that
So
makes
at least it kind of gives that bank the idea that, yeah, we put out a whole bunch this year, but these are the things we've got to show for it. We can't expense them fully for CRA's purposes, but we have retained some of these as go-forward assets.
Yeah, makes sense. So you want to do tax planning with your accountant because you might not want 100% depreciation right away. You might want to slow that depreciation down because you might not have had the cash flow. Understanding that correctly?
Yeah, for sure. I mean, like we always say in accounting and tax, it all depends. What might be good for Bryce might not be good for me. So it's important to kind of have an understanding of that holistic picture of what you're doing, what you're trying to accomplish, most importantly. Because at the end of the day, to me, having that cash flow is a very important thing. I mean, if you're tied up in all these properties and you're struggling month to month to kind of make the payments, etc., you're going to run yourself into problems that might force you into decisions that you don't necessarily want to make. So,
Like selling.
correct. You don't want to be liquidating, and this especially gets into that estate side of things that you talked on earlier. You don't want to get into the position where your estate is forced to liquidate a property in order to make up some cash flow. Maybe it happens to be that family cabin that's been in the family for generations. And if things aren't working cash flow wise for the estate, you're forced to liquidate that to pay the tax bill or whatever other liabilities that the estate brings up. So yeah, always important to have those discussions, have that documentation in hand for the accountant to ensure that you can put together that proper plan as far as tax and cash flow.
So they should tell you what they're looking for as far as tax strategy.
I think so, because maybe your goal is to just buy that one property, you just want to sit on it, you're happy with it, you'd rather park maybe some of your cash there than a GIC at this point in time. But you're just happy kind of seeing that investment grow over time. You're not really looking to be too risky or anything of that nature. That would be, one person's goal.
Yeah.
Another person might be in a completely different boat. They want to leverage things as much as they can. They wanna maximize that depreciation. They wanna drive down their tax costs as much as possible so they can keep buying up properties and keep building that portfolio. So, like I mentioned before, what works for one guy is not gonna work for the other guy. So it's important to have that conversation.
So you mentioned accelerated depreciation. What is this accelerated depreciation, and what classes does that apply to?
For sure. So like I kind of mentioned before, one of these programs started back in 2018, kind of applying to returns in that particular year. Another one started up, I believe, late 2020, early 21. Both of which, again, kind of geared at getting people out into the market, not hoarding their dollars at home, trying to get them to spend a bit more without taking those huge, capital overlays into play and being cash strapped. So one of the programs kind of gives you that accelerated amount. So typically, I'll try and get through this as quickly as possible because it's not the most exciting topic. Typically, like I mentioned before, say if it was a new stove, you'd get 20% depreciation per year. Before these programs came into place, you'd have that option, and in the first year, you'd only get half of that depreciation. So effectively 10% on that particular class. With the accelerated one, instead of getting 20%, you get a multiple of 1.5 on that. So then you're looking at 30% on that as opposed to the 20. Now, when you look at the grand scheme of things, whether you take that accelerated amount or you don't, if you kept that asset for its extended life, amortized it out for the whole period of time, the depreciation expense that you're going to get is going to be equal. You're just going down a different path.
Right.
Maybe you front load it a bit versus kind of just evening that out.
Yeah.
There's another one that applies during that COVID period in which you can fully depreciate an asset.
Oh, wow.
So if you're bringing in a larger piece of equipment, again, maybe this doesn't necessarily apply to a residential property per se, but if you're buying a commercial property, maybe you've got some fairly big addition in there that you need to put some dollars out, you can go ahead and fully depreciate that in the year of purchase. So again, does it make sense to do one or the other? It kind of depends. Typically, for our clients, we kind of stray away from that fully depreciated option just due to the fact that it produces a lot of kind of ebbs and flows then. You might have a fairly nominal tax bill in that first year, but then the second year, you don't have access to that write-off pool anymore. You've used it all up.
Right.
And then therefore, taxes could be significantly higher in that second year.
Yeah.
So I think for the most part, I would say we kind of like to see things, as even as possible. I think that gives the
Stability.
Yeah, it gives that typical investor the ability to plan for the future. And, I think, depreciation's maybe one of those things that gets forgotten a little bit. So if you go 1 year and you've got this, big expense, not a big tax liability, maybe you're anticipating the same thing down the road and it's not there, it can throw a bit of a wrench in your plans.
So if I buy that commercial building and say it's got like a crane in there, can I establish a value for that crane and then depreciate it 100%, or would I have to do a depreciation schedule?
Gotcha. So in that particular case, I think that crane could go in as a separate piece of equipment. In that regard, you could have the option to either accelerate it, fully depreciate it, or kind of pick something in between there to say, this is what I need this year versus, because you're allowed up to a threshold and you can kind of then claim from 0 up to that threshold. So sometimes, it might apply for a client to use the whole amount, or maybe they only need part of it because there's no sense generating a huge loss if there's no reason, no availability to carry that back to recover taxes.
Totally.
So yeah, that would be kind of one way of looking at that. If you were to say buy a residential property, which I think you're well accustomed to.
Yeah, that's gonna be my next question.
There you go. So if you're getting into that space and maybe you're doing a bunch of work in there, you're replacing the floors, things of that nature, those particular items are just gonna kind of follow along that building and end up into that class 1.
Okay,
They just kind of blend into that same pool, and you just keep increasing that particular pool as you make those particular renovations.
okay,
So yeah, I guess the differentiating thing would be, is it just a rental that's in the structure of the building, or is it a separate piece of equipment that theoretically you could take that crane out, someone else could use it somewhere else?
yeah,
Whereas if I replace the floorings in the boardroom here, probably no one else is going to take the flooring and put them somewhere else.
Right.
So it just becomes part of that building.
okay, yeah. So I can't do it with my outlet covers, it just becomes a class 1.
With that, and I guess that's a distinction you want to make too. So, you know, as far as CRA goes, if you are looking to put something into that class, I would say $500 is kind of your threshold as to determining whether it's, you know, maybe an expense or a capital item.
Yeah,
So if you're purchasing some outlet covers, or you're doing some repairs on a wall when a tenant moves out or something to that effect, generally I would probably say that those would just end up in rentals, just expense the whole thing and be done with it.
okay,
The big things I would say that you would want to then consider to add to that building class, you know, maybe you re-roof the shingles. Maybe you tear out a sidewalk and put in a new laneway. You know, some of those bigger items that are basically going to give you and your tenants some value outside of that year that the expenses incurred.
yeah,
I think that's probably a good way to kind of look at it in conjunction with that $500 amount.
so, well, those are great answers.
For sure.
So I'm incorporating.
Okay.
First time incorporating. Talk to me like I'm 5.
Okay.
How are dividends taxed versus salary in the corporation and on the personal side?
Okay, fair enough. It is a question that comes up with many, many new business owners.
And lots of 5-year-olds.
Lots of 5-year-olds. You got it. So, I guess we'll maybe touch on the corporate side first, and then we can look at the personal side. So overall, at the end of this little discussion, we'll kind of see that the tax system's fairly well integrated. And depending on what route you choose to take, the dividends and the wages should be fairly similar.
Oh, okay.
So what ends up happening is, if you go and incorporate, maybe you decide to be an employee first. Obviously, you're going to have a new deduction for the company. So you're gonna have your profits, and the wages come out of those. That's a deductible corporate expense. In conjunction with the wages, you're gonna have some potential payroll taxes. So in your case, as a business owner, you would be subject to CPP. You'd also have ongoing payroll taxes taken up.
Okay.
That would be kind of the one route to take. Next route is if you go down that dividend path. So if you go dividend route, essentially you're just kind of taking money out on a regular basis. Maybe you pay for some business expenses as you're going along. You pay for some meals, or maybe some supplies come up and you pay for those personally. At the end of the year, fiscal year, typically that's when we would determine what you either owe the company or what the company owes you.
At the end of the year.
Typically at the end of the fiscal year. That's usually how it works out.
That's easy. Then I'd be like, okay, this was this,
That's
this was
correct.
that.
For sure. So yeah, I would say a lot of small business owners maybe go that dividend route.
Okay,
Because
small
it,
business.
yeah, it gives them the flexibility to say, you know, this is what is maybe coming in month to month. Maybe it's not quite stable
Right.
in that first year to 2 years.
Yeah, that makes sense.
So then it gives you that flexibility to just kind of take money as it flows into the account. So with that dividend, say you get to the end of your fiscal period, you owe the company $50,000 from taking funds out over the course of the year. Your dividend then would be that $50,000. Whereas on the salary side, you would probably sit down and determine, okay, I need X dollars over the course of a month to pay for my mortgage, my food, my kids' activities, etc., etc. You'd probably set your salary to kind of deal with that, and then you would be paying in those CPP and tax amounts on a monthly basis. So one gives you that structure, the dividends gives you a little bit more freedom. Now, if we look at the corporate side of things, like we mentioned before,
Yep.
wages come out of that income,
Mhm.
so it reduces your corporate tax expense. Whereas the dividends, those are paid out of the equity.
Okay.
So those are not a corporate taxable reduction.
Right. Okay.
So now you might say, well, maybe it makes sense to take the wages, obviously that's reducing my corporate tax bill. And this is kind of how the Canadian tax system works to kind of integrate things. So yes, the wages reduce your corporate taxable income, but on the personal side then, they're more expensive to you.
Right.
Whereas the dividends, no corporate tax deduction there, but they're cheaper to you on the personal side. So typically when I do tax planning with a client then, and I just sat down with one last Friday to basically go through this exact same kind of procedure.
Which you should do.
Yep, exactly. It's important to do, I would say at least every few years for sure. When you're doing it, I like to look at the entire scheme of things, that whole holistic view, to say, okay, here's the corporation and here's you personally as a family unit. At the end of the day, they are two separate legal entities, but what we're trying to achieve here is the most cash to you as a family unit.
Right. Yeah.
So whether, it comes partly through the corporation, partly through personal, whatever the case is, as long as if we're maximizing the after-tax cash flow to you as a family,
I like that.
that is what we want to achieve. So when you kind of take that into consideration, there's very little difference between the dividends and the wages overall. The big thing that I go through with my clients on a regular basis is that CPP aspect.
Okay.
So as that small business owner that is incorporated, typically when you get a T4, you have CPP taken off the top.
Yes.
On that same side that you don't necessarily see, your employer is also putting an amount out to CRA in that exact same amount. So now as that small business owner and looking at that net cash flow, you have an amount coming from CPP, the business has an amount from CPP. So in effect, you're pushing out twice as much CPP as someone that would be an employee.
Wow.
Why that's a big thing, especially now, Trudeau government put in a number of kind of policies over the last number of years that keep pushing up the CPP on an annual basis. So as a small business owner, I believe this year you're kind of looking at $3,800 yourself, plus another $3,800 for the company, if you're kind of making in and around that CPP maximum wage amount, which is, I think it's in around $60,000. So if you take that into consideration, yes, at the end of the day, those dollars probably will come back to you in some form when you retire. You should get a pension of some case.
Yep.
So I like to kind of include that in the analysis to say, yes, that is your cash flow, with the kind of little footnote saying, yeah, there's $7,000, $8,000 sitting there, you don't have access to it right now. So then when we kind of look back at some of these scenarios that we were talking before, if there is an individual, maybe in your circumstance, just incorporated, wants to keep building his portfolio, maybe it makes more sense to take the dividends, because instead of taking that $8,000 and plunking it into CPP, hoping to get some dollars back when you eventually retire, you can take those $8,000, you can keep putting that into your investment portfolio, your real estate, etc. and maybe the returns there are better than what you think you could ever get on the CPP pension. So it all just kind of depends on your personal goals, your situation, but that's kind of the gist of that aspect of things.
Yeah, thank you.
For sure.
Thanks for the answer.
You got it.
We should have titled this after-tax cash flow.
For sure. Right on. So I guess I wanted to touch on one other one that I guess parlays off this last question. So as a newly incorporated business, there's a couple ways to say look at that investment portfolio.
Okay,
So say you're holding that all personally.
yes.
I would typically recommend that for most people starting out.
Okay.
Reason being is, usually the cash flows are a little bit tighter when you buy that first property,
Mhm.
from what I've seen just kind of from history with clients. So if there are some losses there, they're typically easier to deduct on the personal side. Especially if someone has, a T4 job, they're working at the bank, maybe they pick up that first investment property. If they get a bit of loss for the first year or two, they can apply that against that T4 income and reduce that tax load.
And it can be a loss because we can depreciate it.
There are restrictions in that regard too.
Okay.
So you can use that depreciation to nil out your income on that rental, but you can't use the depreciation to therefore create or expand upon that loss.
Oh, interesting.
So yeah, they do put some restrictions in there.
So if it was in the corporation, there would be less restrictions or no restrictions.
As far as the depreciation, same boat.
Okay.
The big difference being is when you've got those two entities, if you have that loss in the corporation, there's not really a way to deal with that until that corporation starts earning money.
Okay.
So I mean,
Can you carry it over?
you can certainly carry it over. So I mean,
Can
obvious,
you carry it over on the personal?
yep,
Okay.
yep, you could do that. I mean, you would have to be in a position on the personal side to have no income to kind of carry that loss ahead.
Oh, yeah.
Typically, most people have some sort of other income that they would apply that against,
Okay.
just reduce their taxable income, and then that would typically then result in a tax refund, because they probably paid in tax according to their T4 income.
Okay.
So, kind of in looking at that, if you're starting out on that real estate path, usually I would suggest put that first home in your personal name. You've got some better access to deducting any losses early on. And I mean, the intent obviously is to start making money, but
After tax cash flow?
correct? But yeah, early on it could be a little bit easier just to hold that personally.
Okay.
And I guess expanding upon
Yeah,
that.
how do you get it in the corporation?
Sure. So yeah, say you are in this position, you bought one house, things start trending well, they go good, you keep buying. Maybe you have a bunch of properties now. Maybe you're starting to maybe get into this space where you're providing some, repairs, those types of services, and started hiring out. Maybe you've got an employee or two, something like that. Maybe you're starting to be concerned with some liability things. You don't want to have all these properties in your personal name, and you just want to have some sort of division here.
Separation.
For sure, always important. So it can easily be done at any point in time. So what ends up happening, and again, it kind of parlays back to some of those earlier conversations that you had mentioned, what is that ACB? What is the ongoing tax cost? Important to know all these things, because at that point in time when you decide, I don't want this to be held in my personal name anymore, I want it in the company, you can file, it's called a Section 85 tax election.
Section 85.
Yep. And then that allows you to transfer those properties from your personal name into a corporation, and it defers any tax. So typically, if you were to move a property from one entity to another,
Right.
CRA would say, oh, you have a deemed disposition here,
Capital gains.
I want to see my tax money.
Okay,
This election allows you to move property from one entity to another,
that's cool.
kick that tax down the road. So, very easy,
That's awesome.
I guess, in my opinion, very easy election to file, maybe not necessarily for everybody, but as long as if you have those ongoing documents in place, it's an easy thing to kind of put together.
Yeah, keeping your depreciation schedules
Yep.
so you can.
For sure, for
Okay.
sure, because essentially what happens then is, say you've depreciated that building for 5, 10 years. All those tax attributes of that building that you hold personally, that's just gonna get rolled into the corporation and just carry on there. And then eventually, when you do decide to sell it someday, then you realize the actual capital gains tax within the corporation. That would also give you some flexibility down the road as far as tax planning goes. If you sell that building personally, you're gonna have to bring it into income in that year, no matter what. If you bring it into income in the corporation, there's probably, depending on, and we can touch on this in a
Always
second.
depends.
Yeah, there's probably gonna be some high rate tax there that you're gonna have to pay. But the benefit of that is you pay a bit of high rate tax, so in and around 47%.
Okay.
But a good chunk of that, getting you back down to 16%, is refundable to the corporation when it pays out those profits
Okay.
to that shareholder. So you pay a bit of prepaid tax, but you can get that back down the road. So it's kind of a timing thing. And as well, I guess on the personal side, typically you bring that gain in to income at 50%.
Okay.
Same applies on the corporation. And in order to kind of, I guess, recognize that non-taxable portion of the gain,
Yeah.
half of that goes into what CRA kind of notes as this capital dividend account. So any of the proceeds that you get, half of that goes into the CDA account. That can be paid out to you as a shareholder on a tax-free basis. So there's a lot of similarities, but it gives you a bit of kind of flexibility in dealing with that eventual disposal if it's in that corporation.
Okay.
And I guess I can expand upon that
Absolutely.
further
The more
if you want.
information, the better.
Perfect. So if you are getting into that stage where maybe you've got 5, 6 properties, it's quite a bit of ongoing work, maybe you have a few employees, you're deciding, I want to put this into the corporation. Typically, like I mentioned, you're going to be subject to high rate tax because
Yep.
CRA determines that to be investment income in the corporation.
Yes.
So it's not allowing you access to that usual small business rate because it would give a unfair advantage to the individual that is incorporated versus the guy that's holding it personally. But there is, and it's not really a loophole, it's just the way that the Tax Act works,
Yep.
is if you can get to the point where you can build up enough wealth through that real estate portfolio that you can have 6 or more full-time employees working for you, you can then gain access to that small business rate of 11%.
Can they have to be employees that I'm personally paying? They can't be subcontracted?
Correct.
Okay.
So that is probably easier said than done to get 6 employees.
Good goal.
Yep, it is a good goal. One thing you can quite easily look at to knock a few of those off, yourself as an employee,
Yeah.
your wife as an employee,
Yeah.
maybe you have another family member, maybe some kids are working in the business, doing some repair work, etc., etc.
Or if I had because I can have multiple business activities within my corporation, if I've got partnerships, is it like I'm an employee, my wife is an employee, business number 2 is an employee, business number 3 is an employee?
Right. So these employees specifically have to receive T4 income.
Oh, okay.
So yeah, it would have to be an individual that's receiving that T4.
Okay.
But it does give you a bit of flexibility in the fact that you can knock off, maybe a quarter to half of them through family members. Maybe there's someone that you're hiring to do renos on a regular basis.
Okay.
Maybe you have someone that deals with office admin, social media, that type of thing. So you can quickly get into that range of, 5 employees. So maybe it's just that one more person that you need to find some sort of position for.
Hey, let me pay you.
I want access to the small business rate. I will give you a job. But yeah, I mean, I don't think there's a specific full-time quote-unquote definition that CRA puts into this portion of the act. So I think there is a bit of leeway in how you're kind of setting that up.
Yep.
But that's definitely one thing to kind of keep in mind, if you can grow that portfolio to that point,
Yeah.
that once you get there, yeah, maybe it makes sense to put all this into the corporation and then continue to grow it through there. Because, you know, if you're paying tax even into the second bracket personally, you're looking at 30.5%.
Right.
Whereas within the corp, if you could access that small business rate, you're at 11%. So, you know, it's something to keep in mind, not as a, you know, a new investor,
Yeah.
but as you're kind of pushing yourself down the road, definitely something to kind of keep in mind and take advantage of.
I'll have to save this and be like, okay, let's put this on my vision board.
Yeah, there you go. Yeah, and I think it's a realistic goal. I know we've got a couple clients that have been able to move into that space within the last year or so.
That's awesome.
And, you know, you just kind of work in incremental steps saying, okay, well, if you do this, that'll give you an extra employee. If you do this, and like you said, you know, maybe you have some contractors that you currently have in place that are doing some of this work.
Usually subcontractor.
Yeah, exactly.
Yeah.
You maybe just move them over. Yes, it's a bit more headache. You have to deal with the payroll remittances, etc.
Yeah.
But, you know, at the end of the day, maybe you have that person in place that's dealing with the office admin, payroll, social media.
Yeah.
They can deal with that. You can alleviate yourself from
And it's
having
another
to.
employee.
Yeah, exactly. So yeah, just kind of making these small little incremental changes into that operation can maybe get you to that point where you're able to put everything into the corp and take advantage of those rates, so.
So what's your favorite tax strategy when it comes to real estate specifically?
Good question. And I think I'll lead with the "it depends" answer. So, I guess, for me personally, I think it's a good option and a good idea to put your dollars into three kind of categories. You've got one being either you're a small business owner or, you know, a fairly well-recognized professional. I think that's a good source of income. Two, having some good dollars on the market in some sort of diverse portfolio.
Yeah.
And then three, having some funds in some real property, whether it's residential, commercial, whatever the case. I think that gives you the best kind of diversity across all regions, you know.
Time-tested wisdom.
Yeah, if one isn't doing well, chances are the other one's doing well, and you can kind of avoid some of these discrepancies in the market, for sure. So where do you want to put your dollars as far as maybe that real estate portfolio? You're probably maybe a little bit more well-versed on what to do with that. I would give maybe my personal approach to this. I would say if you're gonna put in, and especially maybe for that first-time owner, again, my personal opinion,
Yeah.
if you put those dollars into a property that has more than one income earning suite to it,
Yeah.
I think is probably more beneficial. If you put all your dollars into, you know, a higher end home that maybe you have to rent to a family or something like that,
That's good.
maybe it produces cash flow for the term of that lease.
Yep.
They leave,
Yep.
and then maybe you're left holding the bag for a couple of months
Yep.
while you're trying to find someone to replace them.
Mhm.
Whereas if you bought a property that even said had a suite up top and a legal suite in the basement, chances are if one is vacant, probably the other one's housed with someone.
Yeah.
You might not be making hordes of cash, but I'm guessing if one is gone, at least you're gonna be close to that cash flow break-even point, I would think.
Mhm.
So to me, that would make the most sense, and it would be what I would personally do.
Yeah.
Is-
That's my favorite strategy.
Yeah, just to open up your options, and I think it alleviates the risk,
Yeah.
especially on those early dollars, to say, if one guy disappears on me, at least I've got that other source of rent.
Yeah.
And I think, planning ahead, making sure you've got some reserves to cover things off.
Yeah, your oh crap fund.
Yes, I think that is a very important thing. And again, Bryce could probably give you a bit better guidance as to, the number of months that maybe you need to kind of keep on hand to cover off some of those expenses. But just kind of keeping those things in mind, I think make the most sense.
That's awesome. Oh, yeah, that's a good strategy.
Yeah, and I mean, beyond that, I guess I'm up for debate whether residential versus commercial is better.
Yeah, I'm not sure. I don't know.
You're kind of up in the, I know you deal mostly with the residential side, I think?
Yeah, because like legally suited are my favorite.
Okay,
All my friends own legally suited properties
Okay.
for that exact reason. Live upstairs, rent
Right.
out the basement. Just takes away your stress.
right,
Um,
makes sense.
yeah, I'm not sure. That's why I'm learning.
Yeah, I mean, I guess at one sense, people always need homes. I think there's always gonna be a market for that. Businesses, especially if you're in downtown Red Deer and you look out the window, there are many for lease signs across the street that have been there for, I don't know how long now. It makes it a little tricky sometimes when I think, is that a good place to go park my dollars? I'm not 100% sure. On the flip side, I've had a lot of clients and even relatives say on the residential side, we had tenants in, they have completely destroyed the property.
Yeah.
We're left holding the repair bag. Yeah, they paid a deposit and it's
Yeah.
$750. It is not gonna come
Yeah.
close.
I've had that happen.
Yes. Whereas I think on the commercial side, probably that business owner is fairly invested in keeping that leased location functional.
Yeah, making it look nice.
Yes, because if you have a dumpy business, I'm guessing people are not wanting to come to your business to purchase goods or services. So yeah, I think just like everything, you've got some pros and cons. I think another thing that's probably important, and I don't know if maybe you can elaborate on this a bit. I think there's some people that are very geared to being maybe that landlord.
Yeah.
And I think there are people that are not cut out to be landlords at all.
Yeah.
So, maybe you're looking to get into the market, but you just know that if you have a property on the other side of Red Deer, for instance, you will consistently be stressing about, is the property in good repair? Is the lawn mowed? Maybe you're just, meticulous for the details and you just stress. Is it then a good idea to maybe put out a couple dollars and have a management company
Yes.
take that on for you?
Yeah, always try it in your personal first.
Okay.
If that becomes too much work, give it to property management. If that becomes too much work, then sell it.
Oh, okay,
Yeah.
okay.
Yeah.
So you can probably get down the line and say, this just is not a good idea.
Yeah.
I am going to get too many gray hairs before I ever reap the benefits of holding this piece of
Yeah,
property.
if you'll take away my stress, I'll give you money, and I'll give you lots of money if you take away my stress.
That's probably a good point. Right on. So yeah, I think that makes the most sense. You gotta get into
does make
something that works for you. You're not just in it for a return, albeit that is important.
Yeah.
If it brings you to an early grave, it's probably not a good idea. So yeah, have that conversation with the real estate broker and the accountant to say, tax-wise, does this make sense? Investment-wise, does it make sense? Because I'm sure you've got plenty of experience, like you said, you'd be able to kind of determine maybe what the expected cash flows are.
Yeah.
You probably got some contacts with that property management company to say, here's a good group of guys that I know, maybe you want to touch base with them to ensure that some of that stress is mitigated
Yep.
and life is a little bit easier.
Take away my stress, I'll give you money.
Exactly. Perfect.
That's awesome.
Right on. Anything else you wanted to touch on?
No, that was excellent. I learned a lot, and I'm actually going to review this too, because there's several things in here that I'm like, oh, mental note. I got to go back and learn that, because he's really smart, and I know that I'm getting the surface level, but I know there's a deeper understanding. So I'm excited to rewatch this.
For sure. No, I appreciate that, Bryce. And I appreciate the opportunity to kind of field some of the questions, a little bit of a different experience for me, for sure.
Yeah, thanks for having me.
Yeah, definitely. So I guess, Bryce, typically this is what I do with the guests. I kind of give the audience a chance to touch base with you. Is there a best way to get a hold of you? Phone, email, that type of thing?
Yeah, follow me on social media, Bryce Kander. You can find me on all the platforms, Twitter, LinkedIn, Instagram, Facebook, Bryce Kander.
That's pretty easy.
And is there a way they can come and network with you?
Yeah, aside from the typical things, as Bryce says, I think I'm on LinkedIn, Facebook, et cetera.
He posts really good stuff.
Yeah, I try and keep the content fresh. We do have a networking group here in town that we kind of get out to on a regular basis, bi-weekly meetings. Bryce has been out to a couple of events, hoping to plan another event down in the fall, just to bring small business owners together, do some networking. I think, with business, real estate, all these things, life gets a little bit easier as you grow that network out, and you can find those little pieces to kind of plug in there for sure. So
build your team.
definitely,
Our
always
team.
important, always important. So yeah, I'll definitely put all your information in the show notes for everybody to touch base with you. Bryce is going to kind of take over some of the editing, so I'm really looking forward to some of the content that he puts out on this side of things, beyond what my accounting skills lend me to do on a regular basis. So
You're busy sending people money.
yeah, exactly. We do what we can do, I guess. Perfect. So I think that's it.
Yeah.
For Jared Pallon, Tax Talk Podcast, thank you again for tuning in. We'll touch base again soon, and thanks for listening. Perfect.